Welcome to Course 11 of the MaxLife Commercial Academy, Commercial Financing and the Capital Stack. I'm Ryan Solberg, real estate broker with MaxLife Commercial here in Central Florida. In this course, we're going to break down every major debt product used in commercial real estate, conventional bank loans, SBA programs, bridge and hard money, agency debt, CMBS, and life company loans, and then we'll show you how to layer them together into a capital stack. By the end, you'll be able to read a term sheet, calculate DSCR and debt yield from a lender's perspective, and structure a deal from the ground up. Let's get into it. Let's start with the foundation of everything we're going to cover, the capital stack. Think of it as the ordered structure of every financing source in a deal, ranked by who gets paid back first and who carries the most risk. At the very bottom sits senior debt. It's a first lien, it carries the lowest rate, and it gets paid first if the property is ever liquidated. Above that, you'll find mezzanine debt, which charges a higher rate and takes a subordinate lien or a pledge of equity. Above mezz comes preferred equity, an equity position, but one that earns a preferred return and gets priority over common equity. And at the very top sits common equity, last to get paid, highest risk, but it captures all the upside when the deal performs. Two metrics tie this together. LTV, loan to value, measures senior debt as a percent of the property's value, while LTC, loan to cost, measures total debt against total project cost. Here's the principle I want you to remember. The more leverage you stack on, the higher your blended cost of capital and the higher your overall risk. As I tell investors here in Central Florida, every dollar in your deal comes from somewhere, and the capital stack tells you exactly whose dollar gets paid back first. Get this framework right, and the rest of the course will click into place. Now let's talk about the workhorse of commercial lending, conventional bank financing. There are really two flavors here, and knowing which to use and when is a skill every investor needs. On one side, you have portfolio bank loans. The bank holds these on its own balance sheet, which means more flexible underwriting and structure, but almost always recourse to you personally. Expect loan to value in the 65 to 75% range, amortization over 20 to 25 years, rates that float or fix off prime or SOFR, and a balloon payment due at 5, 7, or 10 years. Those are great for value add plays, mixed use, and deals where a local banking relationship carries weight. On the other side, you have permanent commercial mortgages for stabilized assets with strong occupancy. These want a global debt service coverage ratio of at least 1.25, offer fixed rates for 10 to 25-year terms, and open the door to non-recourse on larger loan sizes. They'll require a third-party appraisal, a Phase 1 environmental, and a property condition report, and they carry prepayment penalties structured as step-down or yield maintenance. Those fit stabilized NNN, retail, office, and industrial. The number tying it all together is the one on screen. Debt service coverage ratio equals net operating income divided by annual debt service, and lenders want 1.25 times as their floor. Master that calculation and you'll think like the underwriter before you ever pick up the phone. SBA programs are one of the most underused tools in commercial real estate, and Ryan Solberg and the team at MaxLife Commercial help owner users evaluate them on every owner-occupied deal. The 504 program in particular has been a game changer for small businesses acquiring their own buildings across Central Florida. The key thing to understand is that SBA is not for investors, it's for operators. If your client owns a business and wants to own their building, SBA should be the first conversation you have. The leverage advantage is dramatic, and the fixed rate SBA second lien through a CDC gives long-term payment certainty. Run the numbers both ways, conventional versus SBA, before you ever call a lender. Bridge and hard money are the jet fuel of commercial real estate, powerful, expensive, and you'd better know exactly how you're going to get out before you get in. Bridge loans from debt funds are the most common vehicle for value-add deals. You buy a 60% occupied retail center, you have a 24-month loan to lease it up, and then you refinance into a CMBS or bank permanent loan once it's stabilized. Hard money is similar but skews toward distressed deals or borrowers who need speed above everything else. I've seen investors close hard money in 5 business days to beat out competing offers. The cost is real. You might be paying 11 or 12% all in, but if the deal math works at that cost, it works. The cardinal rule with any short-term debt: always underwrite the exit before you underwrite the entry. Agency debt through Fannie Mae and Freddie Mac is the backbone of the multifamily financing market, and for good reason. These programs offer the most competitive rates, the longest terms, and non-recourse structure, meaning if the deal goes sideways, the lender can take the property but can't come after your other assets. That's a meaningful protection for an investor running a large portfolio. The programs are accessed through approved lenders called DUS lenders, delegated underwriting and servicing, who are authorized to originate and underwrite loans on the agency's behalf. From an investor standpoint, if you're buying stabilized apartments of any scale in Central Florida or anywhere in the country, agency debt should be your first call. The rate savings versus a bank loan over a 10-year term can be substantial, and the non-recourse feature changes your portfolio risk profile entirely. When you've got a stabilized commercial property and you want long-term permanent financing, 2 executions dominate the conversation: CMBS, conduit loans, and life insurance company loans. They get you to a similar place, but they get there very differently. With CMBS, your loan gets pooled with hundreds of others and securitized into bonds that are sold on Wall Street. These are non-recourse with carve-outs for fraud and environmental issues. They cover loan sizes from 2 million up past 100 million on virtually any property type, and they work well for large stabilized retail, office, hotel, and mixed use. The trade-off is rigidity, strict cash management, where the lender controls your reserves and cash flow, prepayment through defeasance or yield maintenance that's genuinely expensive to exit, and a third-party special servicer handling your loan rather than the originator you closed with. Life insurance company loans are a different animal. Life companies hold the loan on their own balance sheet with no securitization, which means the most conservative underwriting in the market, the lowest LTV, and the strongest required coverage, but also the lowest rates. For trophy assets, flexible prepayment, you negotiate upfront, and a relationship-driven, selective process where not every deal qualifies. Those typically run 5 million up to 500 million and fit Class A, NNN, industrial, multifamily, and long-term holds. And watch the formula on screen. Debt yield equals net operating income divided by loan amount. And life companies often demand an 8 to 9% minimum. That single metric protects them no matter what happens to interest rates or valuations. This is where all the pieces come together. Once you understand each individual debt product, the skill is in knowing how to layer them and how to negotiate each layer to optimize cost, flexibility, and control. Mezzanine debt and preferred equity are the tools sponsors use when they want maximum leverage beyond what the senior lender will provide, or when they want to bring in capital partners without giving up too much common equity. Here at MaxLife Commercial, Ryan Solberg works with investors across Central Florida, structuring deals at every point on the capital stack, whether that's a simple bank loan on an NNN property or a complex three-tranche structure on a value-add multifamily deal. If you'd like help analyzing your financing options, reach out to us at 321-586-2121 or visit maxlifedevelopment.com/academy for more resources. Congratulations on completing Course 11, Commercial Financing and the Capital Stack. You now have a working understanding of every major debt product in the commercial real estate market, how to calculate the metrics lenders use, and how to assemble a capital stack from senior debt all the way through common equity. Your next course is Commercial Real Estate Negotiations, where we'll take these fundamentals into the transaction and teach you how to negotiate purchase contracts, LOIs, and lease terms to protect your position. I'm Ryan Solberg with MaxLife Commercial. If you have questions about financing a specific deal or want to talk through your capital stack, give us a call at 321-586-2121 or visit maxlifedevelopment.com academy. We'll see you in the next course.